Well, hey everyone, my name's Chris Weston, Head of Research here at Pepperstone. We're looking through the gold market, we're looking at some of its key influences, bond market, some of the currency moves that we've been seeing, crypto and whatnot, but it's really, it's about the dollar at the moment. The dollar is in absolute beast mode. I do get concerned because I have been a dollar bull that we are getting to that point where everyone loves it as well. And generally when everyone likes something, it does the opposite. So we are getting to that point, and as traders, we need to time that move. The question is when that time will be coming, because I think what we're going to be seeing is that it's a situation going into the Fed meeting in December that the market is just saying right now the US dollar is the best looking currency out there. There's really nothing out there, maybe the exception of the Canadian dollar, maybe the exception of the Kiwi dollar, which has the same sort of qualities. And that's really pushing up. But again, inflation continues to be the hot debate that we're seeing on the floors. We're seeing the rising gold price rising concurrently with a US dollar strength, and that's very positive indeed. The backword is inflation. So let's have a look at some of the monitors to really go through what we're seeing here. I've got the daily gold chart first of all. We've seen that big move up into 1877. We've seen an engulfing bearish engulfing coming through. Price has managed to hold at the 5-day exponential moving average. A daily close below that level would have probably said to me that we're going to chop around, but really after that engulfing, what we need to now see is a sustained move through 1849 to say, look, the market's had its run, it's had its it's had its party, and now the sellers have regained some control, and we've seen a slight change in the structural ownership. As it stands, when I'm speaking right here, right now, we are seeing these lows being held, and that's something that we watch as we go into Europe and into US trade as well. Obviously, the question is, if we do get a break of those lows there, it's 1849, then we go back to test short positions into the former breakout level 1833, a level that we've been focused on for the last few weeks, really. But in dollar terms, we had a really nice move. We've got the engulfing. This needs work now. Do we now actually hold these lows and actually build again? For a move back into sort of 1877, where we'd look to take a more positive stance. I do believe in buying strength. I do believe in selling weakness. But that's certainly where we are at the moment. If this continues to break through there, 1833 is the level that we're looking for support. Does that now be confirmed? I mean, this is really why it's so important. This former breakout level now, it's such an important level. We broke through it with absolute ease after the CPI numbers, which was so strong. And we go into the next numbers. In fact, let's have a look at my spreadsheet that I've just it's a bit rough, and I apologize for this. But what it does is it shows some of the event risks that I'm looking out for and what will be really important going forward. We saw that we got the UK CPI numbers out tonight, so that should be quite interesting in itself. The US debt ceiling becomes a problem from around the 3rd of December. I think you'll probably actually start seeing market stress into some of those bills for mid-December, but that could interesting move the US dollar from being a cyclical currency where we're sort of beholden to what we're seeing in short-term rates to one where it actually becomes more of a safe haven currency along with the Japanese yen, and to an extent the Swiss franc as well. Although I think the Swiss National Bank are now going to start intervening in the FX markets. They're going to be selling Swiss franc. You're going to see that coming through in the sight deposit data for longer term. But I think that debt ceiling will become a market event and maybe change the dynamics in the dollar. Be interesting to see how the gold market fares on that. You go down into what is going to be really important. That US CPI numbers on the 11th of December. It's going to be an absolute blockbuster. We're expecting it to continue to increase. Those price pressures will only increase going probably through to the end of Q1. And then they'll start dissipating at coming down at a slightly slower pace. They'll still be problematic, and they'll still promote an idea that the Fed need to raise rates unless we see a situation where financial conditions deteriorate significantly. But we are expecting inflation to continue pushing up a little bit from where the current levels are at the moment. We go into the 16th of December, that FOMC meeting. In fact, look at this whole sort of 24-hour window. FOMC meeting, Bank of England meeting, we're expecting them to raise rates there, and ECB meeting, all within a sort of 12-hour period. It's no surprise then that if you look at the volatility markets, that we have seen implied volatility on 1 month basis, which now covers these meetings, really spike up quite dramatically. But that inflation number is going to be a ripper, an absolute ripper. The non-farm payrolls number coming out on the 4th of December, expecting a really strong number to come through there. And of course, it's the participation rate that we want to watch really very closely indeed. If that doesn't really materially pick up from 61.6%, as those headline job creations that we're going to be seeing from the household survey going to ramp up, what's it going to do? It's just going to see the unemployment rate in the US drop down to where the Fed sees full employment around sort of 4%, perhaps even below into the new year. And we're left with this situation in that Fed meeting here, where on the 16th of December, the Federal Reserve are not just going to upgrade their assessment of inflation, core PCE, for around 3.7%. But they're also going to significantly take down their estimates for next year of unemployment as well. There's probably going to be a very, very good chance that the Federal Reserve are going to accelerate the pace of tapering of their balance sheet and finish off what was expected to be mid next year, probably as soon as April, and perhaps even sort of that April to May window. And that will allow them to raise rates at a faster clip, which is part of the reason why everyone seems to be loving the dollar at the moment. I think that the band is changing now, but that Fed meeting is going to be an absolute ripper as well. So look at this event risk. We've got the debt ceiling. Could be a dollar positive. Well, in theory, it could be a dollar negative, but it depends on what happens with risk aversion in the markets. US CPI, FOMC meeting, non-farm payrolls. Everyone's sort of winding down for a quiet December. Not the markets. We're not going to see that. The markets are saying, you want to chuck some event risk in there? Well, this is going to be a very interesting period. So no one can take a holiday. No one can take a break because it's going to be dynamic. Now, you can actually see that. Now, let's go back to the charts. You can actually see how this is all playing out in the FX markets at the moment. We talk about central bank divergence. When we start learning about currency trading at university or in life, the first thing we're sort of taught is FX trading 101, which is central bank divergence. It's the easiest thing that everyone understands. And we're seeing it absolute case in point at the moment. Who on earth wants to own the euro? The ECB are pushing back significantly. They're adamant that we're not going to get rates in 2022. The Federal Reserve are open-minded. They don't expect to raise rates in 2022. But if the situation warrants, which of course we do strongly believe, or the market's telling you they strongly believe, is going to be the case. So let's have a look at the dollar move before we go back to those gold moves there, because there's some interesting situation. Well, dollar yen immediately, we've just seen that breakout there. I mean, this is probably the most sensitive to rates that you're going to be seeing, but you've seen a lovely breakout in dollar yen. Do we go back to test this the retest 114.51, find a bid, find some support and then go through there, or do we just buy it from at these levels? It's quite over-owned, it's quite over-loved at the moment, but a bit of indecision playing from the daily, one to watch. It wouldn't surprise me if we did sort of go back to test this level and break out and find some support. Dollar Swiss has been a juggernaut, but we're up 6 days in a row, so maybe we'll get a good kickback in there. But the trend is your friend in this one. We're looking for that to come through. Aussie dollars, one I called on Monday in the morning notes. Let's have a look at this because that's just broken through the lows that we've just been seeing there. Can it close? We've got a daily move below these lows. We've got a move off the 50-day moving average. We've got a move off the 50% retracement of this level here. And you can see we're just holding it at the moment. The question is now, will this actually close below that level? So it's make or break time for the Aussie dollar. Are the bulls going to step in and adamantly defend 72.80, or are we going to see a close through there? That's what we want to really see. If it does close through there, then I think shorts for those kind of levels down into sort of 71.60, those kind of areas is looking pretty promising. We can take it across currency because we do have these CPI numbers coming out in the UK later. But have a look at euro sterling. This is testing big levels at the moment. You've got this swing low that came through around sort of 84, which the market's sort of just having a little play around with at the moment. The other one that I really like is Euro CAD. We can talk about Euro dollar, but Euro CAD has broken this trading range. Really very, very powerful break. We sort of consolidated a little bit of indecision there, but we've got the CPI numbers coming out of Canada, 12:30 Eastern Daylight Time tonight. If that's going to be a big one, the market's pricing rate hikes in Canada to be around sort of March period. I would expect the market, therefore, to price in. There's no February meeting in Canada, but they'd expect them to raise rates or look to price a full hike probably for that January meeting, and that should give the Canadian dollar a bit of a kick down as well. And that Euro CAD could be an interesting one. Rather than necessarily playing euro dollar, which of course everyone's been doing, you can see it has now sort of broken this downtrend, the former downtrend. It is oversold, but I'd be selling rallies in that at the moment. So it's interesting to have a look at that dollar is really one way. Again, we can just go and have a look at it on the dollar index and just see that it's really become just bum. But that wouldn't surprise me to see a bit of a reversal in this in the short term, another retest the 5-day, find some support and then back up again. But the dollar's in vogue. Why? All those factors that I just told you into that situation. But we're here to talk about the gold market. Let's go to some of the reasons why we've seen what we have seen in the gold market. Have a look at the inflation expectations. You can see break-even rates. This is the inflation component of real rates, and you can see that's now. Well, I think on the 10-year, it's not a million miles away from all-time highs. Obviously, there's many different ways that you can look at expected inflation. This is one that gets banded around quite a lot, but you can see the average expected inflation over the next 10 years is 2.74 as measured by break-evens, although there's a bit of conjecture because the Fed's buying a ton of them, and also they're very correlated to crude prices and energy prices like nat gas, for example. But you can see as real rates have been moving up, and they've been moving up faster than nominal 10-year treasuries, which are now finding a sell. You can see there's offers there, and we're potentially going to go up to retest these sort of 173 level. But inflation expectations are moving up faster than what we're seeing in generic treasury yields, and that means that real rates have been basically hitting lows, and that's really what a play on gold has been. This idea that if real rates are moving lower, getting ever deeper negative, not just in the US but in the UK and other jurisdictions as well, then you want to be hedged against that. And where's the best place to be hedged? I mean, we can talk about crypto, we can talk about gold, parts of the equity market, but that's really where we've been seeing it. Have a look on that move up there. You can see that in sentiment, the gold market has become quite bullish. So you can see that this is 1 week implied volatility of calls, and we've subtracted 1 week puts against that. So the higher the demand effectively for those options, because you think they're going to go in the money, the higher the implied volatility. So we're looking at that on a relative basis, and we can see that calls are trading rich to puts by 0.73 of a vol. It's not at extreme levels. I talked about this last week. It just really goes to show semantics in the gold market that people are more bullish than they are bearish at the moment. And you can see that, but it's not extreme. My sort of contrarian indicator that we've got too much love being priced in is when it probably trades around 2.5 to 3 vols premium to puts. Not seeing that at the moment. So even though we've seen that nice move up in gold, I don't think that sentiment's too bullish at the moment. I don't think we're too overcooked. Have a look at positioning as well. Have a look at the managed money numbers that come out every week, every Saturday for us here in Australia, every Friday night in the US, and you can see 146,000 contracts. So it's had a nice move up, but again, we're not at extreme levels, very much in fitting with what we've been seeing in sentiment in the options market there. So anyone who tells you that gold's overloved, well, from a positioning perspective, from an optionality perspective, I would argue that that's not quite true. Now let's have a look at the relationship with gold relative to real rates. Again, you can see as real rates have been moved down. So this is inflation. US Treasuries adjusted for inflation expectations. What we look at as a return when we're investors. And you can see that gold as that's been moving up as against this. But you can also see that as real rates have been moving down, the dollar's been moving up, and that relationship is broken down. So you can see that gold has been moving up and the dollar has been moving up at the same time. Some people have said, well, that's a reflection of fear. I'm not seeing fear in the market whatsoever. I mean, if you look at the option space, the VIX curve, you go and look at the different sectors in the market, cyclicals are outperforming defensives. You can see discretionary is doing well. Tesla's sort of a headwind there, but you can really see that this is an inflation move at the moment. So the reason real rates have fallen is because of inflation expectations. The reason the dollar's been rising is because the US is the place that you want to park your capital, and you've seen a rising gold price with a rising dollar, and that's really been where we've been. But the relationship is very true there. What I also like about what we're seeing here is if you have a look at rates markets, you can see a situation where rate expectations are front loaded. So this argument that we've been seeing, and I'm sort of talking on a very big macro scope about the Fed being behind the curve, and I'm obviously saying this before we actually understand Janet Yellen, whether Jerome Powell or Lael Brainard's going to get the gig. Personally, I don't think it makes much difference. I don't think that a Lael Brainard head of the Fed is going to be uber dovish when inflation is obviously a big political issue now. It's not like she's going to come out and keep rates low when there's inflation in the air. No one in America likes inflation. No one globally really likes inflation. It's not a good situation. People don't want to see prices rise. So it's obviously a key battleground as we go into the midterms next year. So having an uber dovish Fed president doesn't make a lot of sense to me. So I think she'll be pretty measured. But look at the rates difference here. So look, the white line basically shows the euro-dollar difference between the December 2022 and the December 21 contract. So how many basis points are priced in? You can see 73 basis points. So between December of this year and December of next year, we can see basically 3 rate hikes being priced in. You go into the blue line, so the difference between what's priced in December 2022 and December 23, you can see 71, so almost 3 rate hikes. But then it just absolute collapses. You've got the orange line, 17 basis points, so not 1 rate hike in that year. And in the purple line, well, we've got 8 basis points, so basically like a third of a rate hike being priced in. So the market is telling you, yeah, we're going to see really front-loaded rate hikes, but then going out, we're not going to see that. In fact, perhaps we may even start seeing rate cuts. If we start seeing rate cuts being priced into this purple, I think the market may even constitute that as, look, you've gone too hard. This is a policy mistake. Maybe we need gold as a hedge in that situation. So I look at the rates markets in terms of the dynamics. Are we sort of collectively spread across the years, or are we going hard and therefore we don't need to raise rates more significantly in the future? The problem with obviously raising rates really hard, really quickly, is that you cause a stronger currency, and you obviously smash inflation expectations, and you sort of set yourself up for a policy mistake where they may have to cut rates at some stage as well. So, yeah, obviously something that we are looking at. So that's the dynamics that we're seeing. We're seeing a situation where it's obviously very easy at this situation to love the US dollar. Is it too overloved? Perhaps. I think we may see a little bit of kickback, but I still remain a staunch dollar bull into those payrolls, into the CPI, and obviously the Fed meeting. We can see that the rates dynamics is very much it's front loaded, and then it's going to sort of dissipate. Any kind of rate cuts that come through in the years ahead, we've come right down from pricing one rate hike down to 8 basis points. If that was to go into cuts, I think that we could see some big risk aversion coming through in the market, because we'd probably be telling you that this is now a policy mistake. But yeah, just going back to those the gold markets, because of course we don't have to buy gold or sell gold in US dollar terms, which again is a sort of make or break time, as we talked about the fact that we've got this engulfing. How does this stage through? But selling in Australian dollars would be interesting there. If we do see that break and a close below that swing low that we talked about in Aussie dollar, then I think the gold price in Aussie dollar terms will break and close above 25.55. So, obviously we want to be long gold in the weakest currency. We want to be short of gold in the strongest. So that break would obviously accelerate that situation. I would probably be looking, given my stance on euro dollar, that it's a sell on rallies. It's probably a little bit overdone at the moment. We may see a little bit of weakness playing through in gold and euro dollar terms. Again, I think that would probably present itself as a buying opportunity. But at the moment, it looks strong. I'll probably be saying long and strong. I don't think I'd be necessarily taking anything off. In fact, if I was long in this position at the moment, I'd just be holding a stop loss just below 16.20 and just let the position ride out. And I think that's really where we are at the moment. So a big December holding up. We're obviously looking ahead. The dollar remains the absolute bad boy of finance at the moment. Can it continue? I think buying opportunities present themselves when we see weakness playing through. And I think, of course, that plays into the gold price. So a lot to look out for. I've done the gold video today a day early because I've got commitments on tomorrow, which means I can't do that. But I hope you've enjoyed this. It's been sort of a whirlwind tour across the markets. I've looked at volatilities. I've looked at sentiment, positioning, the technicals, and obviously the event risk which could propel it. But we do need to see inflation expectations continue to push higher. That keeps real rates low, and that should, in theory, keep the gold price pushing higher. So I hope you liked it. If you do find yourself liking it, smash the like button and subscribe to the channel. And of course, anyone who wants to leave a comment, you can do so as well. My name's Chris Weston, Head of Research at Pepperstone. I'll see you guys next week.